Welcome back to today's Explainer, where we are unpacking one of the most fascinating standoffs in the market right now. We're looking at AZZ Inc., and it perfectly illustrates a classic investing dilemma. What happens when an incredibly high-quality, operationally sound business collides with a sky-high, absolutely eye-watering valuation? You know, it's a genuine tug-of-war between business reality and Wall Street hype. So let's dive in and find out which side is actually winning.
The story really starts with this single staggering number, 247%. That is AZZ's return over the last 3 years. I mean, the stock has been on an absolute tear, recently trading right near its 52-week high of about $162.20. When you see a chart moving up and to the right that aggressively, it immediately begs the question, why? And maybe more importantly, is it actually sustainable?
To understand the stock, we first have to understand the business. AZZ operates in the building product sector, and they basically dominate a very profitable, albeit incredibly unglamorous, niche: hot dip galvanizing. Essentially, they provide specialty metal coatings that protect steel from corrosion. Sure, it's about as exciting as watching paint dry, but it's a fundamental, necessary service for modern infrastructure. They aren't building flashy new tech apps, but they are literally protecting the physical assets of our modern world.
Let's get right into Section 1, 7 Glaring Red Flags.
Okay, before we get swept away by that massive 247% return, we really need to look at the bear case, because Wall Street is largely ignoring some intense warning signs here. Red flag number 1 is a doozy: valuation. Guru Focus estimates AZZ's fair value at somewhere between $80 and $85. Yet, the stock is trading around $150. That implies you are paying a massive 70 to 90% premium right now above its estimated fair value. Even Simply Wall Street's discounted cash flow model estimates the intrinsic value at only $117. No matter how you slice it, you are paying a steep premium today.
Building on that, we hit red flag number 2. The algorithms are practically screaming at us. Guru Focus has triggered up to 8 distinct warning signs for AZZ. Just look at that GF value rank, it sits at a truly dismal 3 out of 10. Combine that with a financial strength rank of 6 out of 10, highlighting some underlying balance sheet concerns, and you really start to see some cracks in the foundation of that soaring stock price. And this brings us to our third red flag. The people who know the company best are taking their chips off the table. Over the past several years, insiders have sold shares at a massive 14-to-1 ratio compared to their purchases. In just a recent 6-month window, insiders sold nearly $3.9 million worth of stock. The most notable one, CEO Thomas E. Ferguson dumped 25,000 shares in February for roughly $3.18 million. Look, when management is cashing out this heavily into a rally, we as investors really need to pay attention. That leads directly into red flag number 4. AZZ is trading at a trailing price-to-earnings ratio of over 23. Now, a high PE is fine, right? Well, it's fine if a company is growing rapidly, but look at that EPS growth rate, just 5.7% per year. Because of that sluggish growth, the PEG ratio sits at 1.99. For context, the legendary investor Peter Lynch preferred a PEG of 1.0 or lower. The math here simply tells us the growth rate does not justify the high price tag.
For red flags 6 and 7, and don't worry, we are saving flag number 5 for our ultimate stress test a little later on, it all comes down to competitive advantage and Wall Street sentiment. AZZ has a moat score of just 5 out of 10. They have scale, sure, but limited pricing power, giving them only a narrow moat. Furthermore, the sheer valuation has actually forced analysts' hands. Wells Fargo recently downgraded the stock to a hold, explicitly citing those valuation concerns. When even the bulls are admitting the upside is capped right now, you know it's a tight spot.
All right, let's flip the script. Section 2, 7 powerful green flags.
Now let's take a deep breath and look at the other side of this tug-of-war. Because despite all those glaring red flags, the underlying business is actually operating at an incredibly high level. Green flag number 1 proves it. AZZ boasts a GF score of 86 out of 100, indicating really good outperformance potential. The internal metrics are just phenomenal: a perfect 10 for momentum, a 9 for growth, and an 8 for profitability. Operationally speaking, this company is firing on all cylinders.
And you know what? That operational excellence shows up directly in their earnings. For green flag number 2, just look at this recent Q2 revenue beat. Analysts estimated $434.5 million, but AZZ actually delivered $448.5 million. That is a 3.2% beat and represents a solid 6.3% year-over-year growth. They didn't just beat the estimates, they expanded their margins and even raised their guidance for the upcoming fiscal year.
Remember those balance sheet concerns we hinted at earlier? Well, green flag number 3 shows management is aggressively addressing them. They have significantly deleveraged the balance sheet, bringing net leverage down to 1.4x. Their debt-to-equity ratio sits at a very manageable 0.39, and perhaps most importantly for their cash flow going forward, they have no major debt maturities due until fiscal year 2029. They've essentially bought themselves incredible financial flexibility.
Green flag number 4 highlights their capital efficiency. A true hallmark of a great business is what it actually does with the money it retains. Well, AZZ is generating a return on equity of 15.32%, which impressively exceeds the gold standard 15% benchmark that's so often cited by top investors. Add in a solid return on invested capital of 11.01%, and it is abundantly clear that management knows exactly how to generate strong returns on the capital they deploy.
So, what does the broader street think of this operational strength? Green flag number 5 reveals that despite the valuation concerns from some folks, the overall analyst consensus remains a solid buy. Firms like Evercore ISI and B. Riley Securities have recently raised their price targets, pointing to a range of $155 to $170. If they're right, that implies up to a 13% upside from current levels. Not too shabby at all.
Rounding out our green flags, we have to look at the macro picture. AZZ is perfectly positioned to ride some massive secular tailwinds: the reshoring of manufacturing back to the US, the absolute explosion of data center construction, and massive spending on grid modernization. All of these megatrends require exactly what AZZ does best: protecting infrastructure. Plus, management is quietly creating shareholder value by modestly reducing the share count by 0.05%. They are doing all the right things operationally.
Let's put this to the test. Section 3. The Investment Guru Test.
So we have an undeniable tug of war here. Amazing operations on one side, a frankly terrifying valuation on the other. How do we break the tie? This brings us back to our missing red flag number 5. We put AZZ through the ultimate stress test. And the verdict from legendary investing frameworks is a near total rejection. Benjamin Graham's value framework gives it just a 14% score, totally turned off by the high PE. Peter Lynch's GARP model gives it a flat 0%. That peg of 1.99 is an automatic fail for him. And Warren Buffett's framework also scores it a 0%, demanding a higher ROIC. The consensus from the masters is unequivocal. The price is simply too high.
Time to wrap this up. Section 4. The final verdict. So where exactly does that leave us? We've seen the red flags, we've praised the green flags, and we've watched the legends totally reject the price tag. The summary is this: AZZ is a classic story of high-quality operations trading at an extreme premium. You have a deleveraging business hitting a 15% ROE, riding massive macro tailwinds. But you are being asked to pay a 70 to 90% premium just to access it. For most disciplined investors, the operational story is absolutely compelling enough for a high-priority watch list, but you probably want to wait for a significant pullback, ideally dropping below that $120 mark before committing any serious capital. It all comes back to this timeless quote from Warren Buffett: "Price is what you pay, value is what you get." AZZ is undoubtedly delivering real value through its services and execution. But at $150 a share, you are paying an awful lot for what you are getting, leaving very little margin of safety if the broader market turns or if growth slows down even slightly. Which leaves us with a final question for you to ponder for your own portfolio. Is AZZ's operational excellence truly worth an 80% premium? Does their market position justify paying tomorrow's prices today? Take this data, look at the frameworks, and decide for yourself. Let me know down in the comments which side of the tug of war you stand on. Would you buy, hold, or run far, far away? Thanks so much for joining me on this explainer, and remember to keep digging into the data. See you next time.